Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. And here's some of the trends we're going to be diving into. It was another day in the red on Wall Street. U.S. stocks showing signs of concern again after rising Treasury yields. Markets also reacted to Trump's tax bill and retailer earnings. All three major indices ended the day down. From Wall Street to Y'all Street, Austin, Texas flourished, we know, as a new Silicon Valley, but there are signs that may be reversing course after workers return to coastal cities in America. We're taking a deep dive into what that may mean for the city's economy as well as real estate at large. And education in debt, the bill is coming due for student borrowing. We're taking a look at what that all means for families and for the economy as a whole. Well, the pandemic changed everything, including how and where we work. Yet some of those changes may now be shifting course once again. Austin, Texas began flourishing as a technology hub, rivaling Silicon Valley. It lured companies and workers out of California with hopes of a better quality of life and lower taxes. 5 years later, the city is losing a lot of that tech talent and money as workers are resuming business along America's coast. So what does that mean for housing and property sectors as a result? Our next guest, Ari Rastegar, is very plugged into this phenomenon. Welcome, Ari, to the show.
Thanks for having me.
So let me start here, Ari, because you're from Austin, which is a city I love, one of my favorite cities in the country. It's phenomenal. But I want to ask you to defend Austin's honor here, because I see this report in the Wall Street Journal. It didn't sound so good, Ari. I mean, here's your headline. Austin's reign as a tech hub might be coming to an end. The subhead, regional tech hubs across the U.S. are losing talent as workers return to the coast, with Austin being one of the hardest hit. What is going on in Austin?
Well, as Twain would say, the exaggeration of the demise has been greatly exaggerated. Look, that's just not what the numbers say. I saw the headline myself, and quite frankly, Austin had such a huge growth during those years. And yes, you've started to see a little bit of settling, but the growth is still double digits. From the housing to the employment, it triples the job employment ratio of tech jobs in the United States. It does rival only, Silicon Valley. And Texas as a general hub is just growing exponentially. If you take, the northern region of Austin and Leander, or in Kyle, Texas, and South Austin, where we own a massive development, they've been the two fastest growing cities in the United States for 5 consecutive years. So those types of numbers, and there's a little company called Tesla, a little company called Dell, that you might have heard of, that are there. And so when you factor in all those things, yes, there's been a little bit of a softening, but the year-over-year growth is still a massive, massive number.
I know that the growth that we were seeing in Austin, one of the things that was triggering was concerns over affordability, particularly for longtime Austin residents. And I also wonder what it meant for investing for people like you. In other words, was it difficult to find better deals in the Austin area as we were seeing these skyrocketing prices?
Absolutely. I mean, you really had to have sharp pencils during that time. And a lot of people are absolutely getting priced out of the market. Some of these, lake houses are $50, $60, $70 million, which are unbelievable. I know in New York and these areas, these prices might not be as shocking.
New York.
But yes, for regular people like us, it's absolutely been extremely, extremely expensive, and you really have to sharpen your pencils. But if you look at multifamily growth, industrial, Samsung is building one of the largest semiconductor plants on planet Earth outside of Austin, $17 billion in hard costs. These aren't those types of numbers and those types of flags that are put in the ground. You don't just reverse them with one headline. Like these are huge numbers that are going to pay dividends, in terms of jobs, in terms of overall logistical growth for the next 10, 20 years.
Let me ask you a broader question, Ari. I could talk about Austin for a lot longer.
And come visit me, please.
Phenomenal.
All of you listening, come visit as well.
Daidue, one of the great dinners I've ever had in Austin. I want to broaden out, though, talk about the housing market more nationally.
Sure.
And what you see there, because I'm looking at Mortgage News Daily, Ari. Tells me the 30-year fix, we're at 708. I mean, that just seems like a constant, brutal challenge. Affordability is tough for Americans across the country. Give me your high-level thoughts of just where we are and where you think we're headed near to intermediate term.
Honestly, it's awful. I mean, the housing need in this country is unbelievable, and it's hardworking Americans just can't buy homes. And I don't understand why rates have not come down sooner. They were too low too long and raised too quick too far too quickly. And what we're going to really see is areas like within this golden triangle of Texas as an example. So from Dallas to Austin to San Antonio to Houston, if that was a country, it would be the 8th largest country in the world. So think about that. Exports in Texas has the highest exports of any state in the United States. Within that area, in the northern parts of Austin, in the perimeters of Dallas, you can still buy houses for $350,000, $400,000. So yes, when you say Austin proper or Dallas proper, yes, prices have gotten very expensive. But a 20-minute drive, which in Texas is a 3-minute subway, you can still afford to buy a home, in maybe a 2-income salary, but it's still absolutely doable. And the growth trajectory, of that American dream of owning your house and it being your retirement is still absolutely alive and well in Texas.
Where do you see the sort of next emerging market, hot market for real estate more broadly or specifically residential?
Well, I'll tell you, I think the most exciting market in the United States is Dallas, Texas.
Why, Ari? Why do you say that?
Well, first of all, next year we will have the Texas Stock Exchange, which we've been calling colloquially Y'all Street. And so when you have Goldman Sachs building a $500 million campus, remember what they did in Battery Park, which seems like a few minutes ago, but 20-something years ago, all the housing, all the growth that happened around, so it'll be their second largest office outside of New York City in Dallas. With the Texas Stock Exchange coming, which by the way, is gonna have very stringent listing requirements. So there's close to 2,000 companies on the NASDAQ that wouldn't even qualify to be on the Texas Stock Exchange because of price requirements, et cetera. So that simple, I would say, initiative to decentralize the US financial markets in Dallas is gonna have a massive ripple effect.
And what does inventory look like in the Dallas area right now? Enough to accompany what you expect its demand to be?
I think it's a great question. Dallas was built to be a metropolis. Okay, Austin, I always joke, is like a town on steroids. It was a little hippie town when I was growing up, and it wasn't necessarily designed in terms of the highways, the water systems, to be what Dallas or Houston, really is. Dallas has that infrastructure. It has the water, it has the power, it certainly has the space, has the airports that can really support that type of growth, and there's enough land as you go further and further out to still have quite affordable housing.
My brother-in-law is a baseball agent, travels a lot. So I always trust him. Whenever he names some of his top cities, Fort Worth gets star billing.
The best.
Yeah.
Fort Worth is Fort Worth has great culture. You have Dallas, and Dallas Fort Worth are somewhat intertwined, but they couldn't be more different kind of markets. But when you go there, you certainly see that Fort Worth is certainly still in Texas.
Down Texas. All right, great to see you. Great to have you on
Thanks for
set.
having
Thank
me.
you. Stick around. Much more Ask for a Trend still to come. Bond yields continue to climb, putting pressure on equities. The Dow sliding more than 800 points. The S&P 500 and NASDAQ also ending the day lower. Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Josh.
Yeah, Josh, it felt like we had a little bit of a mundane day of trading action, and then at 1 p.m., you had a bond auction get some pretty weak demand. Yields took off, and that gave us direction for the equity market, right? So here's sort of your 1 p.m. surge in that 10-year T-note, which finished up 11 basis points, 4.6%. That's your highest level since February. And then I'll flip over to the 30-year here, which is now at its highest level since 2023 and really approaching its highest level in more than a decade if it gets a little bit higher than here. But again, look at that move you saw at 1 p.m. and then I'll just flip to a major index here so you can see how stocks reacted. Let's get to the S&P 500. There's your 1 p.m. sell-off.
Yeah.
So rising yields becoming a concern again for the stock market. Of course, that was something we were talking a lot going back to maybe January to start this year. It's been a on and off theme for the market at this point.
And so those yields, it's not just the levels, it's also just the way we've gotten there. Why have we seen these moves?
Yeah.
What are the
So
reasons?
right now you have sort of the U.S. debt crisis in focus, right? That seems to be a hot topic right now. You also have had, though, inflation expectations have soared over the past month, right? That's something that could push yields higher. And generally speaking, you just have higher, it feels like we've shifted to a higher rate environment in the sense that no one's really calling for the Fed to cut right now, right? So if you just think about the rate picture overall, it is not nearly as dovish as it was go back a few months ago. But yes, with that debt crisis, I think you perhaps get, as our friend Ed Yardeni would call it, those bond vigilantes, right? Saying, well, if I'm worried about the U.S.'s ability to pay back debt, I want more of a return, right? I want a higher yield for that risk that I'm taking. So that's sort of what you're seeing. And I want to show you a chart too, Josh. This is from Michael Kantrowitz over at Piper Sandler, just sort of laying out what moves in the 10-year can mean for stocks. So what we saw today is we moved above 4.5. Kantrowitz highlights that as an issue for rate sensitives in low quality stocks. I want to flip to what happened in the market today. So rate sensitive, low quality stocks, right? Let's look at the sector action today. Sector action today, let's see what fell the most. An extremely rate sensitive sector, right? Real estate. Then if you flipped over right at 1 p.m., again, right? Then if you flipped over, one last thing I'll show you here, if we look at the leaders, and we take a look at where is IWM forming. This is the Russell 2000. A lot of companies more exposed to debt in that sector. 1 p.m., big sell-off. So that's sort of the areas in the market we're watching right now. If we get closer to maybe 5% on that 10-year, then you're starting to wonder about the whole market and if it's just going to weigh on the equity market as a whole.
All right.
Takeaway
point number two.
Number two, Josh, this is a simple one. We had a Bitcoin all-time high today, right? So there's a lot of things that we're getting close to all-time highs. Sort of discussion of, okay, what's going to get there first? Well, it was Bitcoin. Bitcoin crossed 109,500, I believe, was our official number today, right around here. Of course, it came back down with that equity market rally I've been talking about. But then if you just zoom out over the last month, it's been a pretty nice ride for the largest cryptocurrency in the world.
Yeah, so I spoke to Mike Novogratz of Galaxy recently, and I asked Novogratz, listen, you look at gold market cap, roughly 22 trillion, will be as big as gold. That's what Novo says.
That would mean that Bitcoin has a lot longer to run, Josh.
The adoption snowball continues.
All right, we will see. A final takeaway for us here. Stocks aren't all moving together. This was also in Kantrowitz from Piper Sandler's note, and I thought this was interesting. So you heard a lot of talk when the tariffs first came out. The whole market was moving together, right? So what we're looking at here is correlations within the S&P 500 and sort of how the stocks within the index are moving. When we got up to here, that meant that basically the whole market was moving together. That is not a common thing. And so what that does is it makes it hard to really own something and be protected, right? You just saw a lot of areas in the market were either getting whacked or everything was rallying together. Now we've fallen back down over the past month amid this rally, and you're now perhaps in a more opportunistic point where different stocks are moving at different levels and you can maybe make choices as an investor.
So your point being, the takeaway, the investor, the viewers watch this, stock picking could be back.
Yeah, stock picking could be back. And when you think about what's coming up in the next month and a half, 2 months, when we talk about all this economic data that people are waiting to see where the tariffs are impacting, where they aren't impacting, that's a chance to be a stock picker, right? Some companies are clearly seeing more impact from tariffs than others. Some companies would be more impacted if economic data slows. So strategists sort of talking about how to position around that.
All right, we shall see. Thank you, Schaefer. Stick around, much more As for a Trend still to come. Summer is almost here, and with Memorial Day weekend just days away, we are checking in on the travel and leisure sector and which names are best positioned here. For more, we're going to bring in Paul Golding. He is the Senior U.S. Lifestyle and Payments Analyst at Macquarie U.S. Equity Research. Paul, it's good to see you. Maybe start high level, Paul. Summer's here. The sun's out, the pool's open, Paul. I'm just curious. I mean, you cover a lot of names that could benefit or get dinged. You think broadly about the names you cover, broadly about the travel and leisure sector, Paul, as we head into summer. How positive, how constructive do you feel?
Well, Josh, good to be on. As we look at the earnings season conclusion overall for our covered names, and we think about the relatively decent prints that we saw, it goes to show that the consumer, from a leisure perspective, continues to engage well with the sector and consumption. Some mixed actuals over the quarter as we think about Easter timing and also different pricing tiers for different product types, for example. But as we think about cruise, for example, Royal Caribbean delivered a strong result and talked about a record wave selling season, April bookings up year over year. Norwegian, a bit softer on the booking commentary over a 12-month horizon, but relative to historical norms within range. And then when we look at live events like Live Nation or the MSG names, strong demand for live events, consumers going to see concerts and other shows. So overall, no alarm bells. Maybe some shift in terms of tariff concerns on goods, and so services maybe continue to be emphasized, or it's just a continuation of the services trend post-COVID versus goods which were pulled forward during that period. I know it's been a while since we've talked about that, but somewhat still seeing that momentum. So overall, no alarms going off, continue to see strong consumption. And even our card networks, which we cover, saying that the U.S. consumer remains relatively stable.
So no alarms going off. That's a good place to start, Paul. You mentioned, listen, it's summer. People want to go see a concert. If you had to choose a way to play it, because you mentioned Live Nation, MSG, correct me if I'm wrong, Paul, I think you actually like both those names. If I force you to choose, is there one you would prefer, though, Paul?
So Live Nation, outperform rated, a name that's highly scaled, continuing to guide double-digit AOI growth this year. One of those names that continues to see secular growth, not only from venue expansion, but also from market expansion. The Ocesa acquisition for the Latin music genre promotion business, as well as going into Asia. That business is globally scaled. We like that name very much for live events. And as we continue to see good margins from the ticketing business and watching those expand.
Also, listen, during the summer, Paul, we know people like to hit the parks with the families. Six Flags, that's another name in your coverage universe. You know the company very well. Are you telling your clients that's a buy here?
We like the theme park space in general for a couple of reasons. One being the drive-up ease of engagement. When we think about cruise, that has been a big part of that thesis, but theme parks even more so, in the sense that the regional theme parks in particular are distributed throughout the states. And so the ability to use the pass network that some of these park portfolios leverage adds to the ability to drive up, get some reciprocity at a different park, a different experience, but continue to be within that network and enjoy the ability to engage in theme park activities.
All right, of course, a new one too, Universal's Epic Universe. We have that one as well now, Paul. Always good to see you, sir. Always appreciate your time in those picks.
You as well.
Well, the pause on federal student loan delinquencies has officially ended, putting more pressure on consumers with tariffs and broader economic uncertainty. And Yahoo Finance's Julie Hyman joins us now with a closer look in our chart of the day.
Now that the student loan moratorium is over, what effect is that going to have on people's credit, on their ability to spend in general? That's the subject of today's chart of the day. And coincidentally, both Torsten Slok of Apollo, as well as one of our earlier guests, Doug Pita of BCA Research, are watching this phenomenon closely. So this chart looks at all the different types of debt that people hold. But there's one that really sticks out here that we haven't really seen come to the fore over the past couple of years, and that's student debt, where we could see student loan delinquencies spike once they are kept track of once again. Doug Pita, who we spoke to earlier today, he talked a little bit about what might happen as a result.
And additionally, this is only at the margin, and not everybody has student loans, but now student loans that you didn't have to pay for the last 5 years, now there's a new pot of debt that households have to service.
And so one of the effects of having to service that, as Torsten Slok points out, is that up to 10% of U.S. households may face a steep decline in their credit score. That then, in turn, could affect their ability to get loans in different areas, like mortgages or business loans, for example. So you could see a ripple effect. The other thing that Peter was talking about is that because of this happening at the margins, it's just one more thing that sort of affects the post-pandemic come down. There was that enormous amount of stimulus injected into the U.S. economy. That pause on student loan repayments was also a form of stimulus, and we are only now finally getting to the end of that big pot of money, as he put it. And so that's one of the things that could affect consumer spending going forward. But of course, you also have the other types of debt here to contend with as well. And this basically measures the delinquencies on these different types of debt. Credit card, keep an eye on that as well. It is inflecting a little bit higher as we are seeing other types of debt going into that bucket as well. Auto ticking up slightly, but watching all of these things and how they then feed back into consumer spending. Josh?
All right, thank you, Julie. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.